So there will be probably crisis at some point in time. And in that case, you need to have a central bank to provide liquidity to the financial system. And the main difference is that you can say that the traditional system is closed Saturday and Sunday, and we open again on Monday, but not cryptocurrency. They work 24/7. So if you have a crisis happening on Sunday morning, and then you cannot say, no, you have to wait an additional 24 hours until the Fed opened the doors. No.
You're listening to Traders Insight Radio by Interactive Brokers. Find more podcasts and daily market commentary at tradersinsight.news. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show. Let's get started. Hello, and welcome to IBKR Traders Insight Radio Podcast. I'm Stephen Levine, Senior Market Analyst at Interactive Brokers. And today on this program, Yves Longchamp, Head of Research at SEBA Bank in Switzerland, has been kind enough to join us again, this time to talk about central bank digital currencies, or CBDCs. Welcome back, Yves. It's great to have you here with us again.
Thank you very much. Pleasure. Thank you.
When you were last on our podcast, we had a terrific discussion about cryptocurrencies, their growing allures and asset class, the benefits and risks of adding them to your portfolio for diversification purposes. And listeners can also tune into that program on our channel. Found that talk very insightful. But it seems the rise in popularity of Bitcoin, Ether, other coins and tokens, as we talked about, these have somewhat shaken sovereign nations into forming plans to safeguard and perhaps altogether transform the traditional shape and architecture of their own fiat currencies and payment systems. I'd like to start off with your insights into these CBDCs. Now, I understand there are at least two approaches central banks have been taking to develop them. There's a retail version, there's a wholesale version. What can you tell us about these? What are the differences, and are there more benefits or risks weighted towards one or the other?
Yeah, I mean, it's a very good idea to start with this difference between retail and wholesale CBDC, because I think it has a key implications. So retail CBDC is actually the type of currency you and me can use. So it really, it's targeted to you, to, let's say, normal citizen. Wholesale CBDC are completely different. They are only for bank. And actually the idea is very close to what the current situation here exists. For example, if you own US dollar in your pocket with this kind of banknotes, this is, let's say, retail central bank digital currency, because it belongs to the Fed, it belongs to the central banks, but you have it, you own it, so it's for you. But most of the central bank money is actually just on an account that big commercial banks have access to, and this is called wholesale CBDC. So really, retail CBDC is for you. You can use it to buy your coffee or whatsoever, and wholesale CBDC are more for the financial system per se. And there are indeed two ways of creating a CBDC. One would be retail, one would be a wholesale CBDC.
I see. So my bank account then would not be with, say, Chase or Bank of America in the US or Citigroup or any other retail type of commercial bank. It would be at the central bank. I would have my account there.
Yeah, if the CBDC is a retail CBDC, then in a way you will have a sort of wallet to own your CBDC, which would be equivalent. Instead of having one US dollar, you will have one, let's say, CBDC US dollar, which is completely equivalent. So one CBDC US dollar would be equivalent to one US dollar. And actually your wallet or your account will be at the central bank. So that would be the key difference, and this is only for retail. That's right. And obviously the risk is, what does it mean for commercial banks?
It's a huge change, I would say. I mean, it's a massive transformation. It seems that there are a long list of changes, a huge list of changes and risks that seem to come from centralizing all bank accounts at the central bank. But we'll touch on that a bit later. I'm understanding that some reasons for countries to seek out launching these is out of fear that Bitcoin, Ether, or other decentralized cryptocurrencies, they may somehow undermine their existing forms of fiat money. But how do they do that? How would they undermine their existing forms of fiat currency?
Yeah, I think there are two ways. The first thing, let's say, the technology, central banks need to go to the next level. And I think this is what people are attracted with cryptocurrencies because it offers this kind of new service, 24/7, working fine. There's no downtime. You make a payment, you receive the money, it's down in a few seconds. Not that you have to wait for your banks to send, the message that your money is transferred to someone and then you receive. So I think it's something that is really attractive for the financial system.
I see.
But then, in a way, for the central bank per se, and I mean more linked to the idea of monetary policy, the money we use daily is the fiat currency of your own country, which is under the reach of your government and of your central banks. Then suddenly you have a new sort of money that just pop up from nowhere, literally, and is accessible to everyone. You have a lot of freedom and it has value because people accept it, and it goes in direct competition to central bank. It's about trust, and in a way, central bank had the monopoly of trust because you had to accept this central bank money. You had to accept, let's say, US dollar if you were in the United States, and you have no other way to do it. And now it exists a new way, a new digital currency like Bitcoin, can be Ethereum or any other one that works very well, and everyone can accept. And it enters directly into competition versus fiat currency, and it's out the questions about what the future of fiat currency issued by central banks.
I'm seeing that there's maybe a two-pronged dynamic going on. There's that trust factor, and so there is that spotlight that's placed on the ability of the country to honor its debt obligations, the trustworthiness of the government's fiscal management, as well as central bank monetary policy. There's also utility. What can I do with my digital currency when I have it? I can only really transact maybe with a vendor that accepts them, but it would have to become more broadly or widely accepted.
Yeah, but I mean, yes, but imagine that the value of your own currency is just, kind of disappearing or fading away slowly. And actually, at some point in time, you won't be able to. I'm just thinking about Argentina, for example. In Argentina, you have your own currency, but everyone is holding a US dollar because it's a way to store value. And more people are accepting US dollar, even though it's not allowed, just because it's a good alternative. So you can create a sort of an alternative payment system, and prices will be more in US dollar than their own currency. If you have broad adoption, you will be able to use Bitcoin, Litecoin, or Polkadot, or Ethereum, I don't know what, but just alternative to that.
Yeah.
And especially alternative when you have a simple way to transfer money. Because what prevents you to pay your coffee with gold is that it's painful to have your kilo of gold just to take a piece of it just to pay your coffee. But with Bitcoin, you can do that. And I think, if this negative spiral enters the mind of the citizens of a country that do not trust, because we are back to trust, the future value of something, so they will dump it and find something else. And because everyone will do that, you will have adoptions, let's say, overnight. And then suddenly you have a new financial system. And I think this is with a blockchain, which is a fabric of trust, where you have a settlement system, a messaging system, an accounting system, a way to record value transparently and so on. So really create trust. And this is really available here now, easy in a way.
Yeah.
And I think that's really something. I don't know if it's a threat, but it should be a sort of something that should create discipline to central banks. And I think no one complained about the Fed to print money to save the financial system. That was a good idea. But you need to have discipline. You need to understand. And at some point, you're going to say too much is too much. And I think people tend to say, yeah, no, it's too much.
Apart from the cryptocurrencies posing a threat, I've heard other rationales for CBDCs, and these seem to be centered on combating the potential for illicit activities. China, for example, they started a pilot program to introduce a digital yuan. They recently placed a blanket ban on all cryptocurrency transactions and mining. They view the technology in part as a vehicle for conducting criminal activity like money laundering. And even more recently, the U.S., I think in this executive order that President Biden had signed in early March, I believe March 9th, they also cited the potential for illicit activities on decentralized exchanges, terrorist financing, for example, or skirting foreign financial sanctions regimes. These are reasons why the U.S., or at least in part, said they should examine how they can best produce a CBDC. But even with the possible advent of, say, a digital dollar, how could the U.S. work to prevent this type of activity, this illicit activity, from taking place on a decentralized exchange? Do they have any jurisdiction over the decentralized exchange, or how does that work?
Yeah, actually, there are many points you are mentioning here. I would say that, cash, if we go back to the cash we have in our pockets, there is no anti-money laundering check. Everyone can have the currency in your pocket, and, the value is linked to the money. It doesn't, I don't care who gives me the US dollar. $1 is $1. So in a way, there is no KYC, no know your clients, no AML, anti-money laundering check. Usually, central banks have delegated this task to the commercial banks, because if you want to open an account and use electronic form of money, then you need to show your identity. You need to explain where your source of income is coming. So you need to check. And with retail CBDC, then actually you will have an account directly at, let's say, your central banks. And then the question is, will central bank perform this kind of check? And to be honest, I'm very unsure about that. I think this is not what they want to do. I think that what will happen is maybe they will restrict the size of, I don't know, maybe a few $1,000s you can own in CBDC in your wallet. So in a way, if you use it for, let's say, you don't really need to check carefully what you do, because it's just a few $1,000s. It doesn't, you will not make huge illicit activities with that. So I think this is probably a kind of a cost-effective way for central banks to provide that. But I think one of the key reasons, and because actually, yeah, you mentioned also this idea of about the yuan, about this People Bank of China is issuing this kind of CBDC, and obviously they own the information as well.
Yes.
Because if they provide it, because it's a central bank, so it's not a decentralized type of cryptocurrency. So there's kind of paradox as well. So the technology is the same, but if you have only one computer checking everything, this is centralized, and then you get all the information, and then you can create a social score on that. So actually your freedom is at risk. So something which is key is also, if you have retail CBDC, then you need to have a privacy layer on the top of that. And think about cash. Cash, you have a privacy layer. If you pay with cash, no one knows where this money comes from. So retail CBDC is fine, in my opinion, as long as you have a privacy layer on that. And maybe just here as an example, because SEBA participates with Banque de France to sort of a CBDC experiment, which has been done on Ethereum network. And actually, we use Ethereum to settle transaction, but on the top of that, there was a privacy layer. So that from the outside world, and even from the, let's say, from the inside, no one knows, who did what. So there was also some kind of privacy, and I think this is very important as well to have that.
With all digital technologies, there is the ability, one way or the other, for somebody to game that technology, to hack into it. If all developed countries, central banks created digital currencies, wouldn't they all be very vulnerable to an attack? And then what happens to the entire global financial system in that sense? I mean, that's a very scary prospect.
Absolutely. I think that's a central point. Bitcoin has never been hacked. So the Bitcoin blockchain has never, ever been hacked. However, if you have your Bitcoin not on the blockchain, but let's say on a decentralized exchange, then the exchange can be hacked. So, I mean, there is a difference between the security of the blockchain and let's say, well-established blockchain, let's say Ethereum and Bitcoin have never been hacked. Okay, long time ago, Ethereum has been hacked. There was a fork with Ethereum Classic, but that's kind of that's, I would say that's long time ago, and I think it won't happen again because it's too expensive to hack it. It's almost impossible to hack it. So I think if you use this well-established, high valuable cryptocurrency, then the risk is extremely limited. Obviously, I should never say never, but I mean, it's extremely low. And this is not by chance that, for example, Banque de France choose Ethereum to make this transaction and not a smaller smaller blockchain. And so, I mean, from that point of view, I think the risk is extremely limited. The problem would be more about the wallet, because to own your cryptocurrency, because you cannot have it in your hands, so you need to have a sort of interface. Yeah. And certain types of interface, or user expense, or for example, if I want to pay you a coffee or, something like that, I would have to transfer this money. And if I do it via sort of a different interface, then that could be the risk. So really, I think it's very important to mention that big, well-established cryptocurrency and blockchain are not hacked. Obviously, there are always fun examples of small one that you can hack because the security is low. But most of the time, hackers attack exchanges because this is the weakest link in this environment, because you bring your crypto out of the blockchain, try to make something to exchange it, and then put it back to the blockchain. And when it's out, it's like when it's, most of the time a bank is not hacked. You get your money stolen when you have your money outside the bank in your pocket and you are taking the metro in New York, for example. But this is not the fault of the bank. This is not the fault of blockchain. This is you having your money not in a safe environment. Yes. And I think that's a key element. That's a key element.
You bring up digital wallet. So
yeah,
let's talk a bit about this digital wallet, because another reason for the U.S. exploring a CBDC appears to be focused on financial inclusion. And this is interesting to me. Indeed. Because according to a fairly recent FDIC survey, around 5.5% of U.S. households, just north of 7 million people, were unbanked in 2019. And this means that no one in the household had a checking or savings account at a bank or credit union. But around the same time, the U.S. Census reported that 8% of U.S. households didn't own at least one type of computer. So no desktop system, no laptop, no tablet, no smartphone, right? So it's a lot more people that, according to the census, didn't have means to any kind of computer. So I suppose the first question is, a household without a bank account may prefer not to have a bank account. So would they be forced into having this digital wallet? If a digital dollar was introduced, would they be forced to bank now?
Yeah, that's an excellent question. I suppose there's a good correlation between the people who are unbanked and the people who don't have a computer at home. I don't know why people don't have a computer, and I don't know why people don't have a bank account. Maybe they don't need it. But I think maybe you can solve both this issue, because I strongly believe that to have a decent financial infrastructure with financial services is a big plus. Very often you need to have at least once in your life a credit to do many things, to build a house, to get education and so on. So financial primitives are key. And for that, you need to find a way to enter into it. And the question is why people don't have it, because they don't trust the bank or they don't have enough money to have a bank account. I think that CBDC could be a way to access DeFi, decentralized finance space. Yes. And decentralized finance, to be honest, does very much the same as what a bank is doing. Do credit, you also lending, borrowing. You can also, do also some kind of asset management, so managing your money. And you can do it directly 24/7 from your sofa. So you don't need, to go to the next city. And maybe if you have that and you can get credits, then maybe it's also encourage people to get the IT infrastructure needed to do that, because it's really offer new services. And I think this is what, digital money should do, is really to allow more people to have access to simple financial services, which I believe are part of the modern society, and that we build our growth on these financial services.
Yeah, you would hope that those without a bank account and without any kind of computer access, that the digital dollar doesn't get introduced before they have IT access. Otherwise, it would seem that they would have a challenge in buying that IT access.
Sure, sure. That's right. Yeah, but I think again, to have a CBDC doesn't mean you won't have fiat anymore. For example, we have e-banking solution for a long time, and actually most of us. I mean, I don't have any real money in my pocket for ages.
Yes.
And most of the time I use my, we have a different solution in Switzerland than the US, but which could just pay with your mobile phone and so on. I'm pretty happy with that. But still, I think it's key to have a fiat money. And I can well imagine that for a long time, digital money didn't kill fiat money. I mean, the physical cash. And I think CBDC, for me, there is no reason for CBDC to kill fiat. I would need to have that. And I think my mom, for example, will certainly not have a CBDC wallet. And I think she will still be very happy to use banknotes. And I hope she will live long. So I hope that we still have some cash in the next, let's say, 25 years at least. So I think it's different. But we see anyway kind of transition. We are getting more used. We are getting used to the facility, the simplicity of money or digital cash. And I think for most of our payment, we are very happy with that. But again, I think we need to have a privacy. We need to have a form of money that offers privacy. So either that would be retail CBDC with a privacy layer, and I would say even better would be to have cash, because cash is the only coins that offers you full privacy and freedom as well. And it's not about doing, illicit activities. You may have good reason to use both because this is your choice. And this is your freedom.
And digital fiat currencies, I'll call them, right? Digital currencies for sovereign nations, central bank digital currencies. These aren't without precedent. I mean, they are now in existence. They've been launched. They've been rolled out by central banks, not in developed nations, I understand, but in countries like Nigeria, the Bahamas. There's been adoption of a central bank digital currencies in countries in the Eastern Caribbean Currency Union. I suppose any adoption of a CBDC would rely on differences, right, across the geographies or regions. But would you say that there are any takeaways from the rollout of these central bank digital currencies in these countries for developed countries like central banks like the Fed or the Bank of England, the ECB, Bank of Canada?
So I haven't talked to them, so I don't know exactly what they learned from this experience. But I think it's, when you mentioned that, I'm just thinking about mobile telephone, for example. In a developed country, we had this kind of a landline infrastructure, which is legacy. And very often you have a new emerging market that come with new solutions because they have there was no way to contact anyone. So you come with the newest technology. And the countries you mentioned, don't have a strong financial sector, a big legacy financial system. So they need to come with it. So they are very open to new solutions that are probably less expensive to implement and provide a lot of benefit to the users, because if you have no phone and suddenly you have one, you are happy, and actually you don't have any. We should stay with the old technology. I think for the developed world with well-established central banks and well-developed financial system, you need to update a big system, and you need to offer. As a user of the financial system, I'm Swiss, so I have a bank account, obviously, so I'm a user of the Swiss financial system. I will use it if and only if the user experience is as good as what I have. Because why should I use something which is not good? And I think that this is something that's need to be created. So I think that, in my view, CBDC has to develop in two ways. First, they should create a sort of user interface that allows you to do exactly what you have done so far, even cheaper or even better, or even the seamless, so you don't realize. And the second thing is, in my opinion, that central banks realize that blockchain and cryptocurrency are there and it's not just a hype. They will stay. There's a lot of, Bitcoin, as you mentioned, legend hedge fund managers say, I bought Bitcoin. Everyone is kind of talking about that. It's really everywhere, Bitcoin in the mind of everyone, and everyone wants to have it. And now on the top of that, you create DeFi, decentralized finance, with new services offering to everyone, even the unbanked.
Yep.
That's right. But the new financial sector, which is developing on the blockchain, is not better or not more stable than the old traditional system we have. So there will be probably crisis at some point in time. There will be a sort of crypto Lehman moment as we had, 15 years ago. And in that case, you need to have a central bank to provide liquidity to the financial system. And the main difference is that you can say that the traditional system is closed Saturday and Sunday, and we open again on Monday, but not cryptocurrency. They work 24/7. So if you have a crisis happening on Sunday morning, and then you cannot say, no, you have to wait an additional 24 hours until the Fed opened the doors. Yeah. No. So I mean, we need also to link these two systems. One, it's a real-time, instantaneous settlement system. And the other one, which is working on let's say, with much more time to process the information, with a clear time from 8 to 5. And I think we need also to make that. So I think CBDC is also here to link this new world and to create a world with some kind of lender of last resort, with some kind of financial stability at the end. I think it's also, so you need to offer something which is good so people use it. But there was also a good reason for central bank to be interested in it, not because they really want to, but just because they realize that, there is innovation, and innovation will not wait for central banks. So central bank need to catch up to make our financial system as stable as possible. I think it goes both ways.
What's at risk if we have, say, retail CBDCs? Let's say all of our customer accounts are with the Fed, which means that I'm not banking, and we touched upon this earlier, with JP Morgan or Bank of America or Citigroup or otherwise, any other commercial bank in the U.S., and I'm, can name them off and, around the world if this happens. But okay, so in the U.S., my account is insured by the FDIC up to a certain amount.
Right.
Does that continue anymore? Would the central bank assume all the roles of commercial banking, including lines of credit? Would my checking account go away? And so, again, all of these transactions that you and I would make through a central bank digital currency would be instantaneous, as we talked about. So there would be no more delay in terms of waiting for checks to cash or to go through or to clear, right? What happens to the bank's operations if they no longer have access to their customers' deposits? That's one big question. And the other is, what happens to bank stocks?
Yeah, I mean, let's say in terms of deposits, and I think this is why retail CBDC will not be, let's say, the types of CBDC we will see. Because if this is the case, why would you hold your money at a commercial bank that's maybe, bankrupt tomorrow? They may be a bankrupt. Just choose directly for the best currency, because the Fed will never be bankrupt. And no central bank can be bankrupt. They just need to print money if needed. So actually, you should go there. And if this is the case, then obviously it's not good for commercial bank. This is why I believe that retail CBDC is not, let's say, the solution that the solution that central bank will show. They will go more for wholesale CBDC. That said, there could be some kind of a small amount you can use, like cash, which is literally, when there is a bank run, the only thing you want to have your money, you want to feel, to smell your US dollar banknotes, because they have value. So you need to have a way to get access to it, because in the fiat currency world, this CBDC or the banknote are the best kind of quality you have. If you have money on your account, if the bank is bankrupt, you don't have money at all. If you have $100 in your pocket, you have it. Nothing can happen. Then the next question is about the purchasing power of it. And I think that's two different things. So this is why I think first, retail CBDC, in my opinion, will not be what will be proposed by main central bank, except maybe to have a few $1,000s on your pocket. That's fine. Then the thing is about the competition and about the trust. And this is what you mentioned. And here, this is where I mentioned at the beginning, there is competition.
Yes.
It's like, everything that we have in the financial sector is within the financial sector. It can be fixed income. It can be, equities and so on. It's linked to the value of the currency. And if you're afraid of, let's say, a collapse of the financial system, a huge devaluation of your own currency because quantitative easing you believe has been too large, or quantitative tightening which is coming you believe will, let's say, kill the economy, destabilize the US financial system or whatsoever. I don't know whether you choose your scenario, but let's say that you have a really bad scenario. In that case, you want to have something which is outside the financial system. So most of the time you say, I can buy real estate. So if I have fresh water and some cows and a farm, I will survive. It's outside everything. It has value per se. Most of people buy gold as a financial asset, which is the liability of no one. And then you can also imagine cryptocurrencies to be the liability of no one because they exist by the simple fact that they exist and they have the value that the society give to it, but the value of Bitcoin is linked to the trust we have in this system that create trust per se. And so we have also an outside money. And I think this is where the competition is high for central banks to, I think competition, or let's say, when you have an option, if you have no option, you cannot know whether it's good or bad because you have no option. You cannot compare. If you have an option in outside money, then people may move outside your own fiat currency towards something which you believe will survive longer. And if this is the case, then in a way, you're putting pressure on your own currency. And I think this is a sort of a new thing that exists. Before it was gold. Now we may have Bitcoin, we may have another one. And I think this is really putting a pressure on central banks to become more transparent, more rigorous, about the way they manage their monetary policy. But obviously, there was the financial crisis, and this is where we are today. And the question is still open about the future of dollar, future of fiat currencies.
So this makes a lot of sense to me. The adoption of a central bank digital currency and placing a spotlight on the unregulated or decentralized nature of the cryptocurrencies perhaps gives the central banks more of a perception of trust in that sense.
Yes.
When comparing. I've got one last question because this is always really exciting when you have the prospect of an entire system or industry changing, like an industry changing. If cash currency transforms into all digital currency around the world, it always seems to affect or necessarily will affect those in the ecosystem of what's being changed. So those companies that are traditionally servicing cash or fiat currency as we know it today, they may change their business models of some kind, but an entire product goes away, right? I mean, if you talk about companies like National Cash Register, NCR, they were founded, in Ohio in the 19th century. Also, Sharp makes cash registers, so does Casio. So what do you think is going to be the future of these kinds of companies in terms of their stocks or related exchange-traded funds? I can go on with other kinds of institutions that would change, like the U.S. Mint, I suppose, changes its operations completely. And then we have an obvious fallout effect in terms of employment and a shift in the landscape.
I agree. I think we have an innovation which is coming that will change the society. And, we have been innovation in the past as well. And, there are some jobs that existed before that do not exist anymore. And I think that will be the case. I mean, for everything which is linked to the notion of money, of transferring money, you just don't need them anymore. I mean, if you want to go to the current situation about SWIFT, for example, this world, messaging system to transfer money. The question is also, do we need it?
Yes.
And the question is probably not. I mean, from a technology point of view, no, you don't need it anymore because you can live without. For example, any blockchain is allow you to own, transfer, and to record transactions. So it's a settlement system at the same time messaging system. So it's a sort of a Swift enhanced or plus. You don't need it.
Yes.
But to come back to your question, yes, I think that it will have a deep impact on all the financial services. I think that many financial services will be offered directly via applications. Like when you have on your smartphone, you have a few applications. On your blockchain, you will have a few dApps, decentralized application. One of them will be financial, let's say decentralized financial application. You will be able to exchange money without talking to your bank, but doing via a smart contract. You will be able to do lending, borrowing. So some people will lose their job. And also in the banking system, you have a lot of people which are just controlling if what you've done is correct, checking, so auditing, validating elements. And if a blockchain is, and this is actually what it is, a messaging system and a settlement system at the same time, there is no reconciliation needed. The transaction is the settlement. It's not that you transact and then, you have to check. And actually, there will be, in my view, also, if blockchain, let's say, become mainstream and is used as an operating system for the financial industry, I think that there will be huge impacts on jobs for all, let's say, back office job linked to reconciliation. I think it has huge impact indeed.
Yves, this has been a really great discussion. Thank you again so much for taking the time and coming back and joining us.
My pleasure. Thank you very much. Always a pleasure.
And for our listeners out there, you can learn more about cryptocurrencies in SEBA Bank's webinar presentation, Digital Assets, What You Should Know for Your Portfolio Diversification at IBKRwebinars.com. You can also keep abreast of their market commentary at IBKR Traders Insight at tradersinsight.news. We can also catch our previous podcast, Crypto Coin Talk, making heads and tails of digital assets if you haven't already. Until next time, I'm Stephen Levine for Interactive Brokers. Thanks for listening to Traders Insight Radio. As always, there's more content at tradersinsight.news. And if you're interested in learning more about Interactive Brokers, visit IBKR.com. We offer more trading education materials such as webinars at IBKRwebinars.com, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction. There's a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Interactive Brokers is not affiliated with and does not endorse or recommend any third-party investment information, advice, services, or products discussed in this episode. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.